All right, so the office building, we purchased this, just a little insight on the back end of the lending side. So we purchased this building for $300,000 about a year ago. So we did a 5-1 ARM, which is a 5-year adjustable rate mortgage, which is very common with commercial lending. So they will give you a fixed rate. And then this one, we actually kind of did a 6-1, I think it is, where the first year was just interest only. So it gave us a little time to renovate the other building. And then now we are using our time on this back one. So we got tenants in the first one, which is in another video. So I think our rate is 6.5, and then, which isn't bad. So usually your rate for a commercial, always buckle, whatever the five-year treasury yield is. So if it's 4, it's usually 2.75 above that, so it'd be 6 3/4. Depending on your lender, it could be 6. Depending on how much money you put down, it could be 10. So, but usually they go off the baseline of the 5-year treasury yield, which I think today it's at like 4.2, but they want to see the average throughout the last 6 months, and then the lenders may adjust their rate, may not. Obviously, in 2020 and 21, the 5-year treasury yield was like 1. So you could get, we have some properties that are 3 3/4, 4.5% range. And unfortunately, those are going to come up in 26, 27, and that rate's going to be, 6 3/4, 7, just depending on what the 5-year treasury yield is. So that's what a lot of the local banks go off for the 5-1 adjustable rate mortgages. It can hurt or help you. If the rate's lower, then you get a better rate. If they go up higher, it is adjustable. So a lot of people are scared of an adjustable rate. They're like, oh my gosh, they could charge me anything. They could, but if you do your due diligence and you kind of know what you're buying and you have a good lender and a relationship, it is what it is. So like most people get a 30-year fixed on their home, right? So they're like, all right, I'm gonna be in this loan to term, take it to term for 30 years. It's 2026, so 2056, I'm gonna pay 6% interest. It's like, that's a good feeling, so you're monthly out of pocket for the next 30 years. Unfortunately, taxes go up, insurance goes up, and then your rate changes anyway. You pull a HELOC out on your home, which is a home equity line of credit, so you're pretty much using your house as the bank and withdrawing money out. The good thing about that is you're not taxed on that income. So if you take out a $100,000 HELOC on your house to buy another property, you're not taxed on that money because you're just not. If you sell the house and take the $100,000 out, now you're paying income taxes on that. Depending on how long you've lived there, there's a bunch of other stuff where you might not pay any taxes. So the name of the game isn't to not pay taxes. You obviously have to pay taxes. Sometimes you can defer your taxes. Sometimes you can't. And sometimes you can. For example, if you file, let's say you buy a house for $300,000, and in 3 years it's worth $800,000. You sell it. You and your wife, your spouse file jointly. The IRS, you can take up to $500,000 tax-free. You don't pay any capital gains tax on that, as long as you've lived in the house for the last 2 out of 3 years. So you'll see a lot of people will take a house, they'll buy it, live in it for 2 years, buy another house, renovate it, live in it for 2-3 years, sell it, buy another one, sell it, and they do that. That's the smartest way to make money, I feel. I haven't done that, unfortunately, but only done it once. People do that and they move every 2-3 years. So depending on your situation, that might make sense for you. If you're just a single guy, single woman, you can do that as well, but you can only take up to $250,000 of capital gains tax and pay zero income tax on that money. A reason they do that, I think, is they go, hey, Brent, you did really well. You bought this property, you updated it, you sold it for more. We can tax more on it. Great job. Go buy another one and do it again. And then you do it again. So it's kind of incentivizing you to take that money and put it in another property, which can create more jobs. Tradesmen can come in, kind of keep the ball rolling economically. So these are just my opinions. None of this is true. I have no idea what I'm doing. So always do your own research. That's my allegedly trademark. Anyway, so yeah, that's kind of, I kind of went down the rabbit hole there. Sorry, but I'm just thinking the information that I have that I can give you guys, and yeah, if you have any questions about any of that stuff, let me know. Just my main pro tip is make sure you have a really good lender and you create relationships with multiple lenders. And just remember, at a closing table, when you're buying a property, everyone at that table is getting paid. You are the only one putting any money in the game. Everyone else is getting paid. Your realtor, the title agency, the seller, your attorney, the other attorney, the seller of the property you're buying. So everyone is happy and smiley because you're paying something and you're locking in to pay for something for a long time, hundreds of thousands of dollars potentially millions of dollars, and everyone at that closing table is getting a paycheck except you. We'll see you on the next video.